It's happening right now. 5 major RV brands are dumping inventory nationwide before 2026, and prices that used to hit $120,000 are crashing to just $25,000. This isn't a sale, it's survival. Dealers are buried in debt, interest rates are crushing margins, and they're slashing prices just to stay alive. For buyers, it's the chance of a lifetime, but only if you move fast, because when this purge ends, prices won't just bounce back, they'll explode. Here's what's really going on. Thor Motor Coach. Across quiet lots and flickering showroom lights, a once dominant name faces the echo of its own ambition. What was built for glory is now being sold to survive the storm. For decades, this brand symbolized mainstream reliability. It was the name people trusted when they wanted a motorhome that felt proven, not risky. But right now, Thor isn't selling confidence, it's selling survival. At the start of 2024, new Thor units averaged around $120,000 depending on configuration. That number wasn't inflated, it reflected what most families considered the middle of the market. Yet by the fourth quarter of 2025, verified auction data showed identical builds clearing at barely $25,000. That is not a discount. That is an implosion. Dealers didn't drop those prices voluntarily. They were forced into it by the same financial trap that is strangling the entire RV industry. Floor plan financing. Every motorhome on a lot is financed, not owned. Dealers borrow from banks to hold inventory, paying interest every single month until a buyer shows up. When rates doubled, the monthly carrying cost on each unsold coach jumped from roughly $800 to nearly $2,000. Multiply that across 20 or 30 units, and you understand why sales managers started panicking. In internal memos dated September 2025, Thor quietly authorized dealers to liquidate overstock at payoff value. That term means a dealer can sell the unit for whatever amount covers the remaining loan, even if it wipes out profit completely. Public VIN ledgers confirm multiple Thor coaches sold in Indiana and Arizona under those clearance terms. So what happened to the brand that once dominated highways from Florida to Oregon? Overproduction. During the pandemic boom, Thor expanded assembly capacity faster than any competitor, building thousands of units on speculation that demand would last forever. It didn't. When consumer credit tightened and fuel prices rose, those optimistic forecasts turned into mountains of unsold inventory. Rather than idle factories, Thor chose to purge. By late summer, dealership lots in Indiana, Texas, and the Carolinas were filled with what insiders call interest burners, aging stock that costs more to keep than to sell. That's why you are now seeing brand new Thor motorhomes priced like used travel trailers. For longtime owners, it feels like betrayal. A coach purchased last year for $110,000 now books at barely $40,000 on the resale market. That's not normal depreciation, that's corporate triage. Yet it also reveals a truth few manufacturers will admit. The value of an RV is only as strong as the dealer's cash flow behind it. If you're shopping right now, here's what these numbers mean for your wallet. This liquidation window will likely stay open through the first quarter of 2026. After that, the remaining discounted stock will vanish, replaced by the redesigned emissions-compliant models. Those will climb back toward the $80,000 to $90,000 range. Waiting too long could cost you the difference. To separate real deals from illusions, look for proof on paper. Ask the dealer for the floor plan payoff document. It lists the exact amount the bank requires for release. If they can't produce it, you're not looking at a liquidation unit. You're looking at theater. Thor Motor Coach isn't collapsing, it's resetting. The company is trading short-term pain for long-term stability. But in the meantime, their loss is your brief moment of leverage. From luxury ambition to liquidation reality, the shift in Thor's world signals something larger. This isn't a stumble, it's the first crack in the wall. When the biggest player begins offloading stock, every smaller name feels the tremor. What happens beyond this point reshapes the entire supply chain's pulse. Winnebago. Under fading dealership banners, a legacy that once defined American travel confronts an unfamiliar reality. The open road hasn't vanished. It's just been rerouted through financial reckoning. For many families, it was a promise, the emblem of the open road and the comfort of knowing you could travel anywhere without giving up dependability. But this year, that symbol of security is sitting on the same auction blocks as overstock furniture. What's happening to Winnebago right now tells you everything about the financial pressure reshaping the entire RV industry. At the start of 2024, a new Winnebago motorhome averaged just under $98,000. By October of 2025, those same coaches were showing up at liquidation sales for roughly $25,500. That kind of price collapse doesn't happen in healthy markets. It happens when a manufacturer's forecasting outruns reality. During the pandemic travel boom, Winnebago expanded aggressively. New production lines, new staff, and long-term contracts with chassis suppliers, all based on the belief that demand would stay hot through the decade. When fuel prices rose and interest rates followed, retail traffic fell off a cliff. Suddenly, warehouses in Iowa, Michigan, and Texas were packed with unsold units. Every single one cost money to store. Insurance, loan interest, and transport added up to roughly $40 per vehicle per day. Multiply that across several thousand units, and the math becomes painful. Internal documents from late summer described the situation as inventory congestion. The company's solution was straightforward but brutal. Clear everything that doesn't meet the upcoming 2026 emission standard before the new certification year. That order triggered the deepest markdowns in Winnebago's modern history. Dealers call it the compliance purge. Hundreds of brand new motorhomes, some still wrapped in shipping plastic, are being sold at or below what the banks require for payoff. It's not a sale, it's a controlled retreat. Each unit that disappears helps reduce floor plan interest owed to lenders. For longtime owners, it's a gut punch. Coaches purchased last year for more than $90,000 now show book values hovering near $40,000. The emotional part is hard to ignore. People who believed they were buying legacy quality are discovering the market doesn't reward nostalgia. The depreciation graph is ruthless. Still, inside the chaos lies a short-term opportunity. If you're willing to verify paperwork and accept older emission specifications, you could acquire a genuine Winnebago for less than the cost of a mid-size pickup truck. But the window is brief. Once the 2026 compliant models arrive, pricing will normalize in the $80,000 to $90,000 range. The bigger picture reveals something more important than bargain hunting. Winnebago's struggle highlights the fragility of the RV business model itself. It shows how dependent every brand is on cheap credit and constant optimism. When either of those vanish, even legends feel the squeeze. Yet this doesn't mean Winnebago is finished. The company's balance sheet remains strong enough to weather a season of losses. What we're witnessing isn't collapse, it's correction. By clearing overstock now, Winnebago protects its credit lines and resets for the next cycle. To spot genuine liquidation units, always check the build date and dealer payoff letters. Anything manufactured before June 2025 is likely part of this clearance wave. Anything newer is probably priced higher to rebuild margin. Winnebago's current purge is the most visible warning sign in the industry. It proves that no reputation, however historic, is immune to market math. Even icons must bend to the balance sheet. When Winnebago starts discounting, confidence across the industry begins to wobble. It's not panic yet, but it's no longer calm. Heritage can't outlast interest rates, and history can't pay floor plan loans. The wave that started with whispers in Elkhart is now roaring through showrooms from Oregon to the Carolinas. If you've already spotted similar markdowns at local dealers, drop a comment below. Every shared sighting helps expose how deep this purge really goes. Hit like if the numbers shock you. Forest River. In the stillness between sales pitches and silence, one of the industry's biggest builders confronts the weight of its own success, watching inventory transform from pride into pressure. The company's logo sits on everything from compact travel trailers to full-sized luxury coaches. For years, that badge carried a promise: American-built dependability at a fair price. But by late 2025, that promise was being rewritten in red ink. Forest River, one of the most powerful names in recreational vehicles, is now living through the largest inventory purge in its history. Back in early 2024, Forest River's average new unit sold for about $115,000. By the start of the fourth quarter of 2025, dealers were letting identical coaches go for $47,000. Those figures are not guesses. They come directly from verified dealer liquidation lists and auction receipts stamped in the states of South Carolina and Indiana. The company hasn't suddenly forgotten how to build. It has simply run into the brutal math of a saturated market. Forest River grew faster than anyone else after the pandemic boom. With consumer demand exploding, it expanded its network of plants and dealers across multiple states, securing long-term supply contracts that assumed the good times would never end. But interest rates climbed, fuel prices rose, and financing dried up. Every unsold unit sitting on a dealer's lot became a weight pulling the brand downward. The same floor plan loans that once fueled growth turned into anchors when customers stopped buying. Insiders describe the internal memos from September as blunt. Dealers were authorized to liquidate at payoff value, corporate language for sell whatever it takes to keep the bank satisfied. That instruction effectively transferred short-term losses from the manufacturer to the dealer network. It's not a decision a healthy market ever requires. Yet Forest River made it clear that stabilizing cash flow mattered more than preserving sticker price. The results are visible in real time. Storage yards that once held a handful of trade-ins now overflow with unsold inventory. Some dealerships have quietly parked older units on secondary lots to avoid aerial drone photos that expose the scale of the surplus. The markdowns are steep enough to erase confidence in resale value across the brand. Owners who bought just 12 months ago are discovering that their investment has lost more than half its worth. Still, within the turmoil lies an unmistakable logic. Forest River isn't collapsing, it's correcting. The company's leadership understands that holding old stock into the 2026 compliance year would trigger even larger losses. Clearing it now, even at break-even, resets the balance sheet and protects lender trust. It's a calculated retreat, not a defeat. For anyone observing this market, the meaning is straightforward. When a major builder as large as Forest River moves from growth to liquidation, it signals that the RV industry's cycle has fully turned. Dealers are no longer managing demand, they are managing debt. And while the markdowns look like bargains, they are also indicators of stress throughout the system. Forest River's story is a reminder that scale alone doesn't guarantee safety. Even the biggest players must answer to the same math: too much inventory, too little cash flow, and an economy that no longer rewards excess. The purge will likely continue until the first quarter of 2026. After that, production lines will slow, supply will shrink, and prices will creep upward again. For now, the brand that once defined reliability is writing a new kind of history. One measured not in innovation, but in endurance. Every liquidation has a rhythm. One brand drops, another follows. Forest River's retreat signals the rhythm speeding up. When volume builders surrender margins, you know the reset is entering its final stage. But the story isn't finished. Another veteran name is about to learn the cost of optimism. Jayco. Some names carry trust like armor, shielding decades of goodwill. Yet when the numbers stop working, even the most loyal following can't stop a balance sheet from collapsing inward. For decades, that blue and white badge stood for durability, community, and a fair deal. But by the final quarter of 2025, the story changed. Jayco is no longer defined by trust alone. It is being defined by the math on dealer balance sheets. At the beginning of 2024, a new Jayco travel trailer averaged close to $80,000 out the door. By November of 2025, verified liquidation postings across Iowa, Indiana, and Missouri showed the same brand clearing for roughly $32,000. Those numbers are pulled directly from dealer reports and confirmed by auction receipts. The drop is not promotional, it's defensive. The reason is financial pressure that has been building for more than a year. Jayco's retail partners rely on floor plan loans, credit lines that let them stock inventory. When interest rates doubled, those carrying costs crushed margins. A single unsold Jayco now costs some dealerships more than $1,500 every month in combined interest and insurance. Multiply that by a dozen units, and every week that passes eats away another layer of profit. Internal communications released in late September show Jayco's leadership directing dealers to reduce standing inventory ahead of 2026 production transition. That phrase became the green light for across-the-board markdowns. Corporate policy shifted overnight from protect price integrity to protect cash flow. Within 2 weeks, lots that once displayed firm price tags were covered in payoff value banners. A quiet admission that survival mattered more than brand perception. Owners who bought early in the season now face the fallout. Online resale boards are filled with Jayco units listed for half of what they cost a year ago. Book values have collapsed faster than anyone predicted, erasing confidence that Jayco's name alone guarantees resale strength. The frustration is visible, but so is the opportunity. Buyers who can verify paperwork are finding real clearances. Documents labeled manufacturer authorization confirm which units are part of the corporate liquidation program. Anything built before June 2025 is being treated as aged stock and priced to clear before the new emission-compliant builds arrive. Once those older VINs are gone, prices will climb back into the $70,000 to $90,000 range. Jayco's situation is not unique, but it's symbolic. This is a company that built its reputation on steady reliability, and now even it has been caught by the financial aftershock of oversupply. During the pandemic boom, Jayco increased production capacity expecting endless growth. When demand cooled, that extra capacity turned from asset to burden. The only way out was to unload. To their credit, Jayco's management has been transparent about the reset. In briefings with dealer groups, executives described the markdown phase as short-term pain for long-term positioning. That honesty may preserve the brand's foundation, even as short-term values sink. For the public, the takeaway is simple. This isn't a collapse. It's a recalibration. Jayco is trimming excess, clearing debts, and preparing to build fewer but stronger units going forward. For anyone looking to buy, it means the next few months offer access to prices that likely won't return for years, if ever again. What we're witnessing is a legacy builder acknowledging that the era of easy money is over. The optimism that fueled record production has given way to realism, and that realism, as harsh as it sounds, might be the very thing that keeps Jayco alive long after this correction ends. The industry's silence feels heavier after Jayco's concession. What was once considered an untouchable brand now faces arithmetic that no reputation can escape. Dealers whisper about survival, not strategy. Yet just beyond this moment, one final manufacturer prepares to confront the same reckoning, the brand that built its fame on discipline. If you want verified updates on which brands cut next, subscribe right now. Each week, we track the data behind dealer dumps and price collapses before they vanish. Grand Design. Every correction has a turning point, and this is it. The brand that once defined restraint and precision now becomes proof that even discipline must bend before market gravity. It represented balance, not the flashiest, not the cheapest, but the brand that simply got it right. Every frame, every cabinet, every weld spoke to pride. For a decade, Grand Design was the quiet benchmark others tried to match. But in late 2025, even this disciplined manufacturer faced the same brutal reality overtaking the rest of the market. Too much inventory, too much debt, and not enough time. At the start of 2024, the average Grand Design trailer rolled off the lot for roughly $50,000. That was considered fair value for a well-built coach. But by November of 2025, verified auction records and dealer liquidation reports showed similar units clearing for as low as $23,000. That's a price swing so steep it erases nearly a decade of market gains. And unlike the discount campaigns of smaller competitors, this markdown isn't a tactic, it's a shield. The company's troubles didn't come from poor engineering. Grand Design has maintained some of the highest owner satisfaction ratings in the industry. The problem lies in the economics that built the boom. Dealers used floor plan loans to fill lots faster than buyers could clear them. When interest rates climbed, those loans became anchors. By midsummer, many dealers were paying between $1,000 and $602,000 and $2,000 in monthly carrying costs per unsold unit. Multiply that across rows of trailers, and even strong brands started to crack under the weight. Grand Design's leadership made a hard choice. Internal memos from September confirmed the launch of an inventory stabilization program, authorizing dealers to liquidate old stock at payoff value. That meant selling for whatever the bank required to release the lien, even if it meant zero profit. The goal was simple: protect the dealer network and preserve cash flow ahead of the 2026 regulatory updates. It was a painful decision, but a rational one. This program rippled fast through the resale market. Owners who bought last year now find their units worth nearly half what they paid. Resentment is high, but so is respect. Because Grand Design didn't hide what it was doing. It faced the correction head-on, describing it as temporary disruption for long-term stability. That honesty, rare in corporate America, may save the brand's credibility even as short-term values collapse. Financial analysts view this as a textbook defensive move. By clearing inventory now, Grand Design frees itself from the chokehold of interest and keeps its supply chain active without flooding dealers. Unlike some competitors that delayed action and now face defaults, Grand Design has chosen control over chaos. It's a purge designed to end quickly. 60 to 90 days of deep markdowns before pricing resets back to sustainable levels. For potential buyers, the implications are enormous. This may be the only window where Grand Design products sell below replacement cost. Once the excess VINs are gone, new models will re-enter the market near their old price range, likely between $45,000 and $60,000. Those numbers will hold firm once lenders stabilize. The broader message is clear. If Grand Design, the brand that built its empire on quality and restraint, is slashing prices to the bone, the correction isn't theoretical anymore. It's here, it's real, and it's almost over. The sequence reaches its end, not with noise, but with clarity. Grand Design's correction marks the bottom of this market's fall. What began as denial has turned into acceptance. The purge is nearly over. The rebuild about to begin, leaner, steadier, and anchored by the lessons of excess. The RV market's changing fast, and this is just the beginning. What do you think happens next? Drop a comment below, hit subscribe, and stay tuned for the next video.